Thank you and good evening to all. And thanks, Taxmann, for arranging this event and hosting me on this platform where the connectivity is across various segments, professionals, and people in industry. This is a unique topic where my objective is try to look at some of these provisions of income tax and GST together and see where there's a cohesive approach, see where there's convergence, see where there are issues, and analyze various aspects. So I would take you through some initial aspects of the sources of law before we go into all this so that you get a fair idea as to where we're heading. So just a few slides just to keep the ball rolling as far as the initial topic is concerned. Article 265, one cannot forget, no tax shall be levied or collected except by the authority of law. And it is just not levied, it is also collection, which is a very, very important aspect of Article 265. And taxation includes imposition of any tax or imposed, whether general or local or special, and tax shall be considered accordingly. That's the definition in the Constitution. Tax on income includes a tax in the nature of an excess profits tax. That is again a reference under Article 3629. And the power to levy income tax flows from entry 82, Union List 7th schedule. Just brushing your past. So the journey was 1922 Act, and then we had a series of recommendations, and then post recommendations, so very wide definition of income under Section 224 and the 1961 Act. And we have this decisions which talked about real income. Sunil Siddharthabai, KP Varghese were all very important judgments on real income, but getting slowly academic, we have moved away beyond real income through various deeming provisions, fair market value provisions, guideline value provisions. A lot of things have changed in income tax, but these concepts are still relevant to some extent. And the constitutional power for GST flows from Article 246A. Parliament as well as the state have the power to make laws with respect to GST. And there's a definition of GST to mean a tax on supply of goods or services, except tax on supply of liquor for human consumption. You have the CGST Act, the IGST Act, the state GST and UT GST, and what is taxed is supply. So why we need to focus on the definition of supply is to understand that supply may not be income, income may not be supply. And why would I say that? If you look at the definition of supply, it's basically transaction driven. Supply of goods or services. It could be sale, transfer, barter, exchange, license, rental, lease, disposal. But one of the conditions is that it is made for consideration and also in the course of furtherance of business. So these are two critical elements which would make a transaction taxable. So mere transaction alone is not enough. It must be supported by consideration, and that entire transaction must happen in the course or furtherance of business. And of course, you have certain provisions which talk about a deeming effect or a deeming fiction, where even without consideration, something could be a supply. So ideally, if you go back in time before pre-GST, I'm a businessman sitting in Tamil Nadu, and I got a customer in Karnataka. I would like to do an interstate sale to him. And the customer says, no, I don't like to buy from you because you're going to charge CST and I can't take ITC. So I come up with this idea, okay, I'll open a branch in Karnataka and then do a stock transfer to Karnataka and then sell it to you from Karnataka. So the possibility of stock transfer driven by business was quite large. Possibility of stock transfer because of business needs. I could make a component in one factory in Tamil Nadu, take it to Karnataka and make another component in Karnataka, take it to Maharashtra and make a final product in Maharashtra, and then sell it to the market in the supply chain. So stock transfer per se existed in the pre-GST regime and was not taxable. Whereas GST recognizes transactions between the related persons as taxable. That's why you have the supply of goods or services between distinct persons and related persons as taxable supplies. So that straight away brings me to the interplay. What constitutes supply need not constitute income. So as I said, I may do a stock transfer of goods between Chennai and Ahmedabad. Now, when I do a stock transfer between Chennai and Ahmedabad, I would report this in my GST returns as a taxable supply and discharge IGST on the transaction, and my recipient will also avail ITC. But there is no sale in that transaction. There is no element of sale in that transaction. There is no element of profit in that transaction. And logically, there is no income in that transaction. But if you look at GST per se and the IT return per se, there will be a mismatch. Let us say the turnaround time for the goods spills over beyond a financial year. So the stock transfer could happen on, say, January 23, and the sale from Ahmedabad could happen in June 24. June 23. Therefore, this one financial year is over and the next financial year starts. So you'll have a supply getting reported in one financial year, but the sale of the ultimate transaction and the income of the ultimate transaction will be in another financial year. This is one example. The other scenario is that there is a concept called as inter-unit billing, where the GST law expects you to cross-charge costs. GST law expects you to ensure that if there is a cost which has been benefited by various divisions of the company in multiple states. We're not talking about cost sharing agreements between holding company and subsidiary company, which is quite obvious that there are two entities. I'm talking about costs within the same entity, where one division in Karnataka may bill another division in Chandigarh, in Telangana. That being the case, that transaction would attract GST. It is called as inter-unit billing, and that would be reported in GST as taxable, and there is no income tax on the transaction because there is no transaction which leads to income. In GST, when I receive advances for services, I'm liable to pay GST. But as far as income tax is concerned, mere receipt of advance would not result in income. Unless that activity results in accrual of income, there is no question of income tax on the transaction. Then for related party transaction, income tax has got one approach, GST has got another approach as far as valuation is concerned. So what happens? Something could be supply, but need not be income. And when it comes to income tax assessment, you will find that the financial statements and the GST returns may not match. GST returns and IT returns need not match. And observations in GSTR 9C may not be conclusive. And therefore, what follows is that what could be supply is not necessarily income. Let's look at the reverse. What could be income need not constitute supply. For example, as an assessee, I sell land and building. I'm assuming it is not an agricultural land. It meets all your fancy definition of agricultural income, agricultural land, the bird, flies, and all that you meet. And therefore, it is a land which is taxable. I pay capital gains tax. Now, sale of land and building may attract capital gains tax. I may pay income tax on the transaction. But sale of land and building is neither supply of goods nor supply of services in GST. And therefore, it is not even in the radar of GST in terms of taxable supplies. Employee remuneration. An employee who receives salary would report the salary in terms of income tax. An employee who cuts the salary check has to deduct tax at source in terms of 192. But services by an employee to an employer is not a taxable supply at all, not even an exempt supply. It is neither supply of goods nor supply of services. There is something called as third schedule in GST, which kind of declares certain transactions that are completely outside the ambit of GST by declaring that it is neither supply of goods nor supply of services. I've imported some goods, and before I clear these goods into Chennai, while the goods are coming into Chennai, goods have been dispatched from Germany, I transfer title to the goods. I effect what is called as an high seas sale. I do a transfer of documents of title to the goods before the goods are cleared for home consumption. Now, for me, this is a sale. This is a revenue. I made money out of the transaction. There is a purchase value, there is a sale price, there is a profit in the transaction, there is an income in the transaction. But in GST, high seas sales is not a supply, not treated as a supply of goods or services, and therefore kept in the third schedule. Or I may import goods and then file a bill of entry for warehousing, where I put the goods inside the warehouse. I execute a bond for warehousing. And while the goods are in the warehouse, I scout for a customer and find a buyer and sell the goods to that particular buyer. So this is another transaction where I sell the goods while the goods are inside the warehouse. This transaction is also kept out of GST through third schedule, but this would result in income for income tax purposes. There could be scenarios where there could be any types of compensation that flows to an assessee. It could be a business contract related compensation. It could be a personal injury compensation. It could be insurance compensation. It could be any kind of compensation. But in GST, compensation does not necessarily mean that GST is payable, because GST is supply for consideration. Consideration and compensation are not one and the same. There could be a number of services where GST is payable by another person under reverse charge mechanism. What is this reverse charge mechanism? In GST, normally we have something called as forward charge mechanism. That means A is a service provider, A is a supplier of services, he is liable to pay GST. That's called forward charge. But the law, through a notification, through a fiction, can shift the liability to somebody else. So the recipient pays the tax. Whoever is identified as person liable to pay the tax, that would be called as reverse charge mechanism. For example, my services, legal services. When I provide a litigation service, or when I provide an advisory service on a complex law to a client, now when I raise a bill, the client has to discharge GST under reverse charge mechanism. So he would pay separately GST on this transaction. It is not even as a revenue. It is a payment that attracts tax, and he reports it in his return as a taxable transaction. So obviously that will create some kind of confusion as to income versus supply. Then there are a number of services which are exempt through notification in GST but are liable to income tax. Healthcare services, slum sale, specific works contract services. I'm letting out a house property for being used as a residence. It will fall under income for house property, but it will be exempt under GST. Transportation of goods by road, it's exempt under GST, but it will have income tax implications. Interest or discount arising out of exchange of deposits, loans, or advances. Treasury income by certain categories are exempt in GST, but I will pay income under income. I'll report under income from other sources. Therefore, what it follows is that there could be some transactions which are income but not supply. Like the other way, the earlier slide where I talked about some which are supply but not income. These are two major buckets. Now I'll go into specifics and link both these legislations and see the impact in terms of analysis for our purpose of a discussion. Fake invoices. This is the biggest issue today in the country. Every newspaper item talks about fake invoices. The government is extremely worried about fake invoices. The law gets strengthened year after year, month after month, notification after notification, rule after rule, only to prevent this menace of fake invoices. But what happens in reality is that the amendments are all targeted towards somebody else and not the persons who are actually perpetrator of fake invoices. So basically what happens in fake invoices, that there is an invoice without a supply. This is an illegal transaction whereby somebody wants the benefit of input tax credit, cash flow. So he wants a benefit of input tax credit, and there is an unscrupulous payer who says, look, you want benefit of ITC, I will give you benefit of ITC. How will you give benefit of ITC? I will generate invoices. There is no underlying supply of goods, there is no underlying supply of services, and therefore it just an invoice is raised, tax is charged, returns are filed, GST is registered, and this fellow takes the ITC. Now, so long as the ITC is going on in a cycle, it is okay. But what happens is that the ITC is used to pay pay GST, which means the government suffers a loss. Or the ITC is claimed back as refund, which means the government suffers a loss. Therefore, the revenue loss. So immediately what will happen, the GST authorities will find out somehow, based on intelligence, based on investigation, and action would be taken. So how is the action taken? Statements are obtained from any of the players in the chain. And based on these statements, all entities are issued notices to reverse ITC with interest. In some cases, statements are made to the effect that there are no actual sales. Even though ITC is reversed, sometimes parties would dispute on the ground that that statement was wrong. For example, because of the undue pressure that is applied, somebody may reverse the ITC. Let me give a classic example. A is a generator of fake invoices. But A is, he's got this business pattern whereby he also sells goods to genuine parties. So it is a combination whereby if he does 20 transactions of fake invoices, he also does 20 transactions of good supplies where goods are involved and invoices are also raised. Now B has bought goods from this fellow, received those goods and claimed ITC. Now A is raided somewhere and then A gives a statement saying that, yes, I generate fake invoices and these are my buyer list. And based on that buyer list, B's name is also identified and pressure is applied on B saying that, look, you have bought from A, please reverse it. My transaction is genuine, why should I reverse? There is tremendous pressure of arrest and therefore this fellow is scared and therefore he reverses it. And most cases, he doesn't even ask for cross-examination of A or cross-examination of parties who are given the statement. So adverse findings are made in the hands of B based on statements taken from others. The law is very clear that the assessee is entitled to cross-examination. There are enough judgments which says that cross-examination is a must. But even if you ask for it, you may not get it. But if you get it also, you may not be able to use it because that person might have disappeared. Though you have a chance to ask for cross-examination, you have a chance to counter the statements made by A, merely because you have reversed the ITC before investigation is completed need not necessarily mean that the matter has been accepted or conceded. Because you are reversing the ITC without an assessment. You are reversing the ITC without the show cause being issued or a notice being issued. Voluntarily, you are reversing it either because of pressure or because you are scared or for whatever reason. Now, once the proceedings start in the form of a show cause notice, you will obviously adjudicate the matter, you will fight the matter, you will contest the matter, and the investigation will involve massive collection of data, and then show cause will be issued. You will object to the proposal in the show cause notice, and then there will be a hearing. And after the hearing, there will be an order that is passed. And against the order, you have a right of appeal to the first appeal authority. And then you can also go to the second appeal authority, though it's not yet created now. You'll probably go to High Court when it is not yet created, or go to the tribunal when it is created. So why I'm saying all this is that there is a journey that ultimately will happen after the investigation. That means a show cause notice, adjudication, order. But you have reversed the ITC before itself based on whatever reason. So reversal during any stages need not necessarily mean that the purchases are bogus. Reversal to buy peace or under pressure or coercion need not result in the purchase transaction being negated merely because you're reversing to avoid an arrest, or it could be condition of bail. There are a lot of bail orders passed saying that you reverse the ITC, I'll grant bail. So merely because you reverse the ITC for seeking a bail, does it mean that the entire transaction is a bogus? Now, why I'm saying this? Fake invoice, first level investigation is GST. Second level of investigation is income tax. The purchases or expenditure which you made would be questioned by the income tax department based on the GST investigation. And during scrutiny, they might very well tell you that, look, you yourself have reversed the ITC. You have given a statement saying that I will reverse the ITC with interest also, which means you yourself are abandoning your purchases and declaring that these purchases are bona fide. And therefore, why can't we dissolve the expenditure? So that is where you need to argue and contend that that matter is yet to be closed. I'm still contesting the matter for ABC reasons. And therefore, a reversal need not necessarily mean that the purchases has lost its color or the expenditure is no longer a bona fide expenditure. And in a fake invoice racket, there is also a possibility of cash transactions being involved. See, typically what happens in fake invoice is that A would sell to B, B would sell to C, C would sell to D. None of them would sell. It's only invoices, all paper invoices. And all payments are made through bank. And if payments are made through bank without being goods involved, the money has to come back. Therefore, some kind of cash transaction will be involved. And therefore, there is a withdrawal of money. So the withdrawal of money trail from the banks will be called for. And the IT would question as to why you have withdrawn money, why you deposit money. Those kind of questions also come up. A larger, bigger legal question would be, A reports fake supplies to facilitate B to avail ITC. B reports fake supplies to facilitate C to avail ITC. Can there be a disallowance of purchase in the hands of both B and C? If supply is fake, can the income alone be taxed? So on one side, if the tax authorities are saying that the supply itself is not a genuine supply, it's a fake transaction, it's a fake invoice, you've not made a supply at all, then the income reporting also should be questionable. So how can you say that income alone is taxable even though there is no supply? So those are all bigger questions that will slowly come up. This is just the first tip of the iceberg that the fake invoice racket has just now started in terms of investigation and closure. So based on that, other developments will follow. You will have court judgment soon on various interpretive aspects of this. Now, the fake invoice racket was so powerful that there was an amendment made in the Income Tax Act by Finance Act 2020 in terms of Section 271 AAD. Now, what happens when the law changes? The law changes drastically, and law changes in a very cohesive manner that it covers everybody also who may not be involved in this transaction. For example, without prejudice to any provision of the Act, if it is found that in the books of accounts made by any person, there is a false entry. Now, this false entry was meant for fake invoices, but it can be interpreted to mean anything. Omission of any entry which is relevant for computation of total income for a person to evade tax liability, then AO or first settled authority can direct such person to pay a penalty equivalent to the amount of the false or omitted entry. Drastic consequence. And not only that, 271 AAD subsection 2 allows the AO or the first settled authority to direct any other person who causes the person referred to in a manner to make a false entry. That means the avatar or the person who facilitates this can also be liable to a penalty equivalent to the false or omitted entry. So effectively, income tax has entered into bookkeeping through 271 AAD, even though there are adequate penalty and prosecution provisions in GST for this problem. A fake invoice attracts arrest, attracts criminal prosecution, attracts massive penalties, etc. in terms of the transaction on the person who generates as well as the person who avails. But in addition, you also have penalty under the Income Tax Act. And scope of any other person could be a matter of interpretation. What is the need for another penalty when the expenditure would be disallowed, can be tested under concealment? We have section 276C, which also deals with prosecution, that already covers this. So why should you make it even more stronger? Next, I move on to sector-specific interplay. I'll first look at charitable institutions. Of course, I'm not going to spend too much of time on the amendments to the charitable institution provisions landscape in the Income Tax Act, because today the charitable institutions by itself as a chapter has become the most complex chapter. It has become the old ATHC kind of discussion. It has become extremely complicated in terms of various series amendments and also decisions. So section 11, you're all well aware, deals with the income derived from property held under trust. But what is most important, section 215. So charitable purpose is defined. you have a category of list of items which are qualifying for definition of charitable purpose. And the last one, any advancement of any other object of general public utility. That is a major one that went into this decision of the Supreme Court in the case of New Ahmedabad Authority. So New Ahmedabad Authority, they discussed all aspects, all categories of persons who claimed the benefit of Section 11 exemption based on charitable purpose being object of general public utility. So that proviso became a critical point for examination. And what is business, trade, or commerce? So to some extent, the judgment is most important because it has changed the landscape as far as charitable institutions is concerned. Chambers of commerce, associations, all of them are impacted by this judgment because now the Supreme Court says you cannot engage in any activity in the nature of trade, commerce, or business, or any service unless it is part of your objects. And of course, if it is an activity, it must also be within the limits prescribed in the proviso. So there is a proviso which is triggered if the activity is in the nature of trade or commerce. And as per the proviso, your quantum of receipts cannot exceed 20% of the total receipts. So what the Supreme Court has said is the test of charity is no longer driven by the predominant object. You cannot say, I'm doing this business activity to generate income for this purpose. I'm running this massive seminar to generate money for the purpose of my notable object of charitable purpose. Every activity in the nature of trade or commerce would be tested in terms of the proviso. Flowing back of business income to feed charity is an irrelevant factor. This is what the Supreme Court has said as far as this judgment is concerned. And finally, they've also said, look, each aspect of your transaction would now have to be examined. So if you're charging a fee for an event or a conference or some other activity, is it covering your cost or do you have a nominal markup? If it is just cost or nominal markup, it's okay. It is not an activity in the nature of business. But if you're charging substantial amounts over and above the cost, then that is an activity of trade, commerce, or business. If it is an activity of trade, commerce, or business, you must establish that it is for the purpose of the objects of the trust. Also, you must ensure that it is within the limits prescribed in the proviso to Section 250. So the limits come into play. And of course, the Supreme Court has also said it does not preclude any of the assessee advancing objects from claiming exemption or the tax authorities from denying the exemption. And they also said AO should scrutinize records on a yearly basis. So the entire landscape of charitable trust or charitable purpose not only is rocked by the set of amendments to the provisions, also the compliance provisions, also the forms and filings that you have to be done, and the judgment of the Supreme Court in this. Now I'll take you to GST charitable institutions. A prominent error or understanding of law that is done is that because I have a 12A registration in income tax, I'm not liable to GST. The presumption is that 12A rides over everything, and therefore I have a registration as a charitable purpose, as a charitable activity in Income Tax Act. It should also be charitable in GST. Unfortunately, no. Of course, with a pinch of salt, I'll come to a bit later. There is one entry which gives the exemption, entry 1. Charitable activities specifically defined. For example, if you take income tax, anything for poor, anything for health, anything for medical relief will qualify as charitable purpose. Here, health only in the context of terminally ill persons, persons affected by AIDS, persons addicted to substance addiction, family planning, prevention of HIV, those kind of activities. Advancement of religion, spirituality, or yoga by itself will qualify for exemption. Education would qualify for exemption for Section 11 protection and exemption under registration 12AA, but education must be relating to skill development programs for homeless children, abandoned children, orphan children, mentally abused, traumatized persons, prisoners, persons over the age of 65 residing in the rural area. So education and health is very, very limited in scope. Religion, spirituality, yoga is quite wide. Environment, watershed, forest, and wildlife is quite wide. So you need to look at that kind of a distinction for GST purposes. So the point I would try to make is, well, all institutions registered under 12A subject to compliance of Income Tax Act would enjoy exemption. Exemption from GST would depend upon the definition of charitable activities, and the definition is restricted in scope. One other view is that, am I not a charitable institution? And since I'm a charitable institution, let us say I'm a charitable institution engaged in this particular activity of protection of environment, preservation of environment. So if I'm registered for under 12A, and my activity is also preservation of environment, the exemption says any services by an entity registered under 12AA. Therefore, should not all my services done get a blanket exemption under this category? That is a way of interpretation to say that once I fit into that entry in terms of category, all my revenue should qualify for exemption. That is one view. But the other view is that no, AR, of course, ARs are all rulings in GST, which are very rarely in favor of the assessee, where all of them have said that everything else is has to be tested by their inherent nature of activity and then only will qualify. And one more argument could be for a charitable trust is that supply is liable to GST provided it is in the course or furtherance of business. So if an institution is able to say that their activity is not in the course or furtherance of business, subject to what Ahmedabad authority says, then whether it will qualify for saying that my transaction is not taxable. Obviously, for GST also, when I receive a donation, there is no consideration involved. It's a donation received by the trust, and therefore there's no question of liability as far as donations received. While activities of achieving objects of trust have been recognized in income tax for a period of time, matters will be tested once again in GST because the decisions in income tax is likely to cast a shadow on GST. So what is the practical approach? One approach would be to say that, let me see if I can fit my activity to the exemption entry. And another strategy would be to see if there are other exemption entries which can fit me into some kind of an exemption, or whether commercial operations can be completely culled out and taken into an entry where I pay tax and be done with it so that the basic trust is protected from all kinds of action. The second sector I'm going to look at is healthcare. If you look at GST, anything done by a hospital, anything done by a doctor, anything done by a medicine in terms of healthcare services is exempt. Only one is taxable, that is hair transplant. I don't think I'm equipped to talk on that, but hair transplant is taxable. Cosmetic or plastic surgery is also taxable unless you're able to say that these are on account of restoration or reconstruction of anatomy or functions of body affected due to birth defects or developmental abnormalities or injury or trauma. So if there is an accident and because of that somebody is affected in terms of their face or nose or whatever, and they go for a cosmetic surgery to get back what they had, then that is exempted. But if you're born with the nose and you don't like the nose that you are given by God or nature, whatever you call it, and you want to change your nose, then please pay tax on the transaction. Pay through your nose. Having exempted healthcare from inception, service tax law exempted healthcare, and then GST also exempt healthcare. For the first time, the government has decided that they want to explore one new area, whereby they say that you go to a hospital, get yourself admitted for a surgery, etc. You're in the operation theater, and after the operation theater, you're in ICU for some time. And after ICU, the doctor says that, look, I have to keep you in observation. You better spend some more time in the room. So you come to the room for another 3-4 days. And that room charge is more than 5,000 rupees. Then GST says, please pay 5% on the room charges without ITC. So fundamentally, it is still part and part of healthcare services. You will still be monitored by the doctors and the nurses. You will not be allowed to roam around. You cannot have food what you want. You will be given a diet restrictions. You will be probably on even food through, you could just be on IV. Even then, it's a room and therefore it is not an ICU and therefore there is a GST applicable. It defeats the concept of composite supply in GST because nobody stays in hospital for holiday or recreation. Of course, somebody could stay in hospital to avoid criminal action, but nobody stays in hospital for holiday or recreation. Room stay is part and parcel of your recovery process, post-surgery and procedure, and non-availability of ITC does not serve any purpose. It's got a huge impact only on patients. So, nutshell, no GST on healthcare services, no ITC, but all these hospitals spend a ton of money on equipments, fancy equipments. The costliest of equipments are available for the purpose of providing the best of quality healthcare to patients. But all these equipments come at a cost. All of them come at GST. So you cannot take credit of that, and therefore your cost increases. And ideally, they could have zero-rated healthcare supplies whereby ITC should have been available. But no, we still live with an exemption regime. And as if this was not enough for healthcare, there is a board circular which makes it even more complicated, where it says that if food is given to the patient who is admitted, it is not taxable, provided nutritional doctor has specified it. Food supplied to patients who are not admitted is taxable. Food supplied to attendants are taxable. Food supplied to visitors who have no business but to visit patients and disturb them are also taxable. So all kinds of permutations and combinations exist as far as food is concerned in terms of GST. Pharmacy attracts your tax. For example, a hospital may also have a pharmacy center separately where it buys and sells medicines that will attract GST. Movement of equipment from one state to another. I talked about stock transfer earlier. There is a hospital could move its own equipment from state A to state B. That is also taxable. and then they could allocate cost to another unit, and thanks to a ruling that is also getting tested. So all kinds of issues exist in healthcare services in terms of GST. I'm not spending much time on it except to bring the interplay. One important point I thought I'll cover here is that during the course of healthcare services, you may also get implants. A dentist may give implant something, or a cardio surgeon may put a stent inside your heart. So in the pre-GST regime, the department tried to say that it is a works contract service, and luckily all case laws were in favor, saying it is not taxable. In post-GST, it is treated as a composite supply. Therefore, implants and stents are part and parcel of healthcare. Quickly moving on to income tax. Now, income tax, as far as healthcare or hospitals or doctors or paramedics is concerned, there is no sympathy. You pay income tax. So all the corporate hospitals, any other hospital would be liable to pay income tax unless somebody is claiming an exemption under 1023C. And 1023C, clause IAIAC covers hospital dealing with certain medical conditions. IIIAE deals with such hospital whose annual turn receipts are less than 5 crores. Must not be for profit, must exist solely for philanthropic purposes. And there were also amendments in the context of 11(4)A as well as 1023C to Finance Act 2022. So what is the effect of this interplay in healthcare? The exemption in GST is wider than income tax, which means a hospital which has a host of revenues. The revenue could come from revenue share, from consulting rooms, from patients, from doctors, all kinds of revenues could come into the books. And most of them, or at least all of them, would get exemption from GST. But all of them would attract income tax. And therefore, what would happen is that your income tax would be higher. Your IT return would show a significant amount of profits as well as income, whereas your GST would be nil or a small amount of income. Only a pharmacy will be taxable. And of course, that more than 5,000 rupees room will be taxable. Therefore, when you reconcile the IT returns and GST returns, there'll be queries. Now, this time the turn of the GST authority. GST authority will ask all kinds of questions based on the IT return. Why I'm putting this topic itself is today, that's the reality. GST officer is looking at your IT return asking question. IT officer looking at your GST return asking questions without understanding that both laws are completely different in certain segments or most segments. Let me take the third segment, shares and securities. Now, if I have income from sale of shares, it could be business income, speculative income, or capital gains. Securities expressly excluded from the definition of goods as well as services in GST, which means when I sell my securities, I'm not liable to pay any GST. Therefore, proceeds from sale of security is not at all liable to GST, but it is considered as an exempt supply for the purpose of proportionate ITC. So what is required to be done is 1% of the sale value of security will be taken as an exempt supply for reducing your income tax, somewhat like your 14A of Income Tax Act. Now, the problem is simple. Entire transaction would attract tax under the Income Tax Act. You have 50CA, which talks about fair market value. It talks about rule in certain scenarios. No such concept in GST. 1% of sale value is simply taken as the value of exempt supply. And there is no transaction on the primary, no tax on the primary transaction. A sale of security or sale of security as defined in the SCRA would not attract any kind of GST, but you will report it under exempt supply and you will have an ITC reversal in terms of transactions. Now I look to a major activity which is done, which is search. Income tax 132. In consequence of information in his possession, the authorized officer has reason to believe. And now, of course, the explanation has come to provide that reason to believe as required by the income tax authority under the subsection need not be disclosed to any person, any authority or the appellate tribunal, just to nullify a decision. Of course, there are judgments which say that mere information from CBI that cash was found in possession of the person was undisclosed without any supporting material cannot be considered sufficient for action. But what I'm trying to infer here, while you have enough judgments, etc., an investigation in GST can lead to a search in income tax based on the information shared. The cousin brothers, so information is shared. So you get information shared from GST to income tax will share to GST. So any investigation in GST which is of a serious nature would definitely be shared in terms of CBIC and CBDT meeting up, and therefore that information can lead to a search in income tax. What follows? Now, during a search in income tax, a person decides that, yes, there is something, there is some undisclosed income. I would give a voluntary declaration of undisclosed income at the time of search. Or there is a voluntary disclosure of undisclosed income through a disclosure petition before the conclusion of search. Or the income is offered or surrendered during any IT proceedings or voluntary additions are accepted, or you file this new updated return. So there are enough without search itself. So there could be enough situations where you offer more income than what you have offered in your returns, either because of search or otherwise. Let's take it for search for the purpose of discussion. Now, when income, let us say you're a construction player and you've been searched and you offer income. Can the GST department also infer that this income is from construction of complex services and therefore taxable? Or let us say you're in hospitality business and you've offered income for income tax purposes. Can the GST infer that the revenue that you've offered for income tax is an attribute of services of restaurant and rooms, etc., done by you in hospitality sector? That's a question which I'm going to answer. Can there be an automatic inference that the amount surrendered is also liable to GST? Answer is no. Punjab Haryana High Court in the case of Mayfair held that when 35 lakhs is surrendered to income tax authorities, it cannot be attributable to consideration received for a mandap keeper service in the absence of any inquiry. Which means what? There must be inquiry and a journey with facts and evidence to demonstrate that there is transactions of supply for consideration in GST falling under so-and-so categories. Tribal in the case of Bindra Tent Service held that demand of service tax cannot be made on presumptions. In this case, the service tax demand under Pandal Shamiana based on income surrendered to income tax department. So it's a well-settled law that you have to demonstrate here also that this is taxable under so-and-so category. Merely because somebody has offered income does not ipso facto mean that the income is attributable to the business for which you're operating from. Then you have this host of TDS based queries. Now, income tax is, I don't know. I've seen the journey of income tax from the early years, and when TCS was started, and originally TCS was started, the objective of TCS was for the purpose of unearthing income tax and preventing evasion in evasion-prone industries, timber or liquor, those kind of things were there. But over a period of time, TCS has expanded everywhere, and each and every transaction has got TCS, as well as you have TDS for various transactions. Purchase also has got into the ambit of TDS. Then you have your 194R, you have your 194S, you have all kinds of transactions which attract TDS. Now, what happens? Basically, what is the purpose of TDS? Purpose of TDS is to ensure that the person who cuts a check to somebody, deducts tax at source, pays the tax to the government account, and refers to that particular fellow's PAN number, etc., so that in the system of the income tax, they know that the other person has to offer income because he has received income liable to tax. That is the philosophy of TDS. For this, even one person would do, because it is only for tracking. But of course, the reality is that TDS is almost like an advanced tax collection, because TDS gives more revenue than the actual tax sometimes. So a lot of people have profits which attract less tax compared to the TDS rate. That's why there's a queue for applying for lower rate of tax certificate. So what happens effectively is that when TDS is cut and the reporting happens in Form 26AS, or now your annual information statement, all kinds of questions come from the other department saying that there is a TDS credit in your system, in your 26AS, in your AIS. Why have you not paid GST? Now, the problem is a person would cut TDS or deduct TDS based on his understanding of law. He looks at a transaction, comes to a conclusion that 194J is applicable. That transaction may not attract 194J. He looks at a transaction and concludes that it is 194C. So when a person deducts tax at source, he need not, we used to use this phrase in days when you used to write our exams. When in doubt, deduct. So a lot of people just deduct. So why should I take a risk? Because there'll be disallowance of a particular portion of the expenditure. I'll rather deduct tax at source and pay it out to the government account. Now, deduction may happen, but the income may not even be liable to GST. The service could be exempted, may not be even taxable. Or excess TDS is done. Or TDS is done on reimbursements. Reimbursements are not even liable in GST because of pure agency concept. So somebody deducts TDS on reimbursements or out of abundant caution, or deducts under 195. Place of supply could be outside India and not even taxable, but deduction might happen. Therefore, even though 26AS and AIS may reflect the TDS, the GST would be payable by another person under RCM, and therefore all kinds of questions are being asked saying that this much of, in fact, some of these notices are really bad in the sense that A has deducted this much of TDS. So this much of TDS represents this amount. Therefore, your revenue not offered for GST is this amount. Please pay 18% GST without even specifying the category. So sometimes it becomes very, very difficult because you have to demonstrate that I have actually received that income. And let me give you some more examples. Take a scenario where there used to be an abatement in service tax law. If I'm a works contractor, that means if I'm constructing something with material and labor, etc., only 40% of my contract value was taxable. So I would do a contract for 10 crores. Only 4 crores was liable to service tax. So my service tax return would show only 4 crores. But 194C would be done on 10 crores. And based on the TDS under 194C, the assessing officer in GST, in service tax, assumes that I have not offered 6 crores for service tax purposes. In GST, there are abatements for land, where the entire transaction involves sale of the building, a sale of apartment as well as land. Then there is a 1/3 deduction towards the value of the land. But for TDS purposes, it could come in a different way. So all kinds of questions are being raised by comparing these kind of data, which are strictly speaking not comparable. Then business expenditure. Interestingly, the battle in income tax was long, and I still remember the earlier days when we used to write our tax papers when I did my SW and others would have done their CA. The business expenditure case was very, very interesting. Whether this expenditure is business expenditure or not, whether it is revenue expenditure or capital expenditure, whether replacing a petrol engine with a diesel engine is a revenue expenditure or capital expenditure, all kinds of case laws, all kinds of almost all of them got settled. And of course, there were also debate on what is a capital receipt and revenue receipt. Apple is a capital receipt, revenue receipt, but if the tree itself gives revenue, it's capital receipt. Those kind of examples used to be there. Now, we are reinventing the whole thing because in GST, ITC is available if the goods or services are used or intended to be used in the course of furtherance of business. This kind of mirrors your income tax. So what is business expenditure under Income Tax Act is necessarily, if there is a GST involved, will qualify for credit, thumb rule. Now, let us say the income tax officer disallows an expenditure saying it is personal. This expenditure incurred claimed as business expenditure, this portion of it is personal or the entire amount is personal and disallowed, because 37, one of the conditions is that it should not be personal. Now, GST also in terms of section 17.5 says ITC is not available where goods are used for personal consumption, services used for personal consumption. So, a disallowance in the Income Tax Act for income tax assessment on account of the expenditure being personal can have an impact in terms of your section 17.5. Travel expenses, telephone expenses, vehicle-related expenses, guest house, these will all be tested under personal or business. Then you have 43B. 43B based on actual payment deduction. So let us say I have GST liability, I've paid. When I say paid, it has gone from a bank account. I've debited my bank account. It is sitting in the electronic cash ledger, but GST portal requires me to upload the return and the cash ledger has to be utilized for actual payment of tax. This is not the law. This is not the act. This is the portal. Now, will 43B apply saying that you have not paid the tax? Actual set-off need not be inserted upon and the amount credit should be considered as tax paid, because GST can also be paid from the money has gone out of your control. GST can also be paid through ITC. Payment through ITC is also a payment of tax because there are enough case laws in income tax on unutilized moderate credit in how it is treated in terms of tax. Then comes the peculiar issue. I gave an example of search happening and you offering income and that leading to GST investigation. Now let us look at a situation where you are genuinely liable to pay GST on a transaction. By sheer oversight, you have missed it. Or by error, you have missed it. Or you have misconstrued an applicability of an exemption that has been withdrawn. And therefore, you have not paid tax on a transaction. The officer comes on audit and points out saying that this is taxable, you need to pay. Now I look at it, I talk to my advisor, he says, yes, please pay it. It's clearly taxable. So either on account of pure error and discovery, I may pay the tax, or on account of buying peace, I may pay the GST, or on account of pressure, I may make the payment of GST, or I make an ad hoc payment to cool down the investigation, I make the payment of GST. Now, when I make all these payments, I want to claim it as an expenditure in the Income Tax Act. The payment may be pertaining to an earlier period. So there are judgments also here where the assessee has not deposited service tax but made the payment on being pointed out. It is an expenditure in the course of business and allowable. Gujarat High Court. Input service tax is deductible under section 37(1) of the Act. When such input tax credit is written off in the books of, I reverse my ITC, I can claim that amount also as expenditure. Then comes late fee, interest. As long as late fee and interest is not penal in nature, or it's only compensatory, then I have no issues. But if it's got penal characteristics, then it will be disallowed. Swadeshi court martial will apply. And there are enough interpretation as to what is compensatory, what is not compensatory. CSR expenditure, income tax will very clearly tell you that you cannot claim any deduction of CSR expenditure. GST also tells you that you cannot claim ITC in respect of CSR, but that amendment has come only by Finance Act 2023 and yet to be notified. So whenever an amendment is new and has inserted a new category saying this is no longer eligible for ITC, the logical interpretation would be that it was eligible for ITC for the past. So the amendment has actually paved the way for the past. One can still test the waters for the past period. Now I covered sectors, I covered activities, I covered events such as search and expenditure, etc. Now I look at special provisions and in income tax and their impact in GST. 50B. As far as 50B is concerned, slum sale, tax under capital gains. You have the net worth of the business undertaking that is taken as the cost of acquisition. Net worth is the book value of the assets minus liabilities. As far as your consideration is concerned, your sale price is concerned, full value of consideration with the fair market value of the assets as on date of transfer, calculated as per Rule 11 UAE. So effectively, each item is identified from a fair market value perspective. It's quite chaotic because slum sale concept itself that there is no species of assets, but somehow we have gone through various kinds of amendments in income tax, which has nullified the concept of what is a slum sale. Slum sale is entire thing is sold as a sum for a lump sum consideration. But now because of FMV and Rule 11 UAE, you have species getting examined. Now, what do you look at GST? How do you look at GST? GST says services by way of transfer of a going concern as a whole or independent part thereof is exempt from GST. Now, I have another view here. Without going to the exemption, let us say I have two businesses. I have one business which manufactures electronic components, and I have one business which manufactures potato chips. And for some reason that I decide to sell off my potato chips division or food product division on a slum sale basis. So when I sell off this activity or this entire business as a whole for a lump sum consideration, for it to be a supply, it must be a transaction in the course or furtherance of business. So one interpretation would be that I am not engaged in the business of selling businesses. And therefore, this sale of this entire unit of potato chips cannot be called a supply in the course of furtherance of business, and therefore not even a supply. That is one position. But easier position, low-hanging fruit is the exemption. Why go to all those headache of interpretation? Take the notification and enjoy the exemption, because through the exemption, you can also transfer the ITC as far as slum sale is concerned. So the point I'm trying to make is the slum sale exemption in GST is a reflection of VAT laws and the previous pre-GST law, where one of the conditions which existed was it must be an enterprise value and not a specie asset value. So you have to be very careful in drafting your agreement to ensure that the agreement talks about enterprise value, even though for Rule 11 UAE, you may have species value. Then 50C. I have a property. I have decided to sell to somebody, and I decide to fix the consideration. I decide both of us talk to each other and arrive at a consideration of, let us say, 3 crores. But the guideline value is 5 crores. So guideline value is 5 crores. 50C came into the picture and said that if the guideline value for the purpose of stamp duty is 5 crores, then that becomes your apparent consideration, or you want to dispute it, go to the valuation officer, etc. No such concept in GST. Because first of all, land and building sale is not even liable to GST. It's neither a supply of goods or services. Therefore, what happens in your actual consideration, your 50C valuation, or how does it go, may not have any relevance except from an audit point or a query, etc. And as far as construction service is liable to tax so long as you don't have your completion certificate. Once you have a completion certificate and sell that apartment after the CC and you receive your money only after the CC, there is no GST in the transaction. So here again, you'll have a reconciliation issue between income tax and GST. 50D, a special provision where consideration received or accruing a result of a transfer of a capital asset is not ascertainable or cannot be determined for the purpose of computing income judgment of capital gains, FMV of the said asset shall be deemed to the full value. No such concept. There is no concept of fair market value in GST. The only thing that you have is open market value. An open market value would come into picture when the transaction is in related parties or distinct persons. For example, a holding company sells to a subsidiary company. That transaction will have to be valued in terms of open market value. One would shudder to open up the floodgates of what is open market value, but luckily the rules are very clear, which say that if the recipient is entitled to full input tax credit, then the amount shown in the invoice is deemed to be open market value. Because in effect, what happens, it's only a pass-through. If a holding company bills for 100 rupees on the subsidiary, and the subsidiary bills on a third party on 300, the GST would come in on 300. So why again try to arrive at 300 in the hands of the first seller? You can allow the transaction to flow through ITC. 45(5)(a) of the Income Tax Act. Joint Development Agreement, applicable to individuals in HUF. There is a transfer of capital asset being land. The developer agrees to construct X number of units. It could be an area share, whereby the developer says, I'll construct 100 apartments. I will sell 60 to the market. You keep 40. So 40 is constructed for the landowner. But as far as income tax is concerned, the landowner has parted with the land, and therefore there is a capital asset. There is a capital gains requirement. There are all kinds of controversial case law, Chaturbuji interpretation. When did the transfer take place? Whether it is a year of signing the JDA, or year of granting possession, or year of granting power to sell, just be, so many decisions, etc. Now 45(5)(a) gives you a window by saying that pay the tax in the year in which completion certificate is issued. That is income tax. As far as GST is concerned, you have a complex set of notifications, 6/19, 3/19, etc., which now tells you that the developer must find out what is the selling rate for an apartment, and that rate he has to apply for the construction done for the owner. There are, of course, interpretations which are there, which we'll leave it for the moment. But two critical things is here in GST. When a joint development agreement is signed and development rights are given by the owner to the developer has to pay GST under reverse charge. Under the joint development agreement, when the developer constructs for the owner, there is a GST payable. When the developer sells those 60 units to the customer, he has to pay GST for those customer returns. So in effect, there are three kinds of GSTs that come into picture. All of them will be reflected in your GST returns in different forms. And your income tax will not have any of these transactions except what you sell to the customers. So you have all kinds of issues which will come when these numbers are compared. And today's system compares the numbers and asks you all kinds of questions. 56(2). Receipt of sum of money without consideration where the aggregate value exceeds 50,000. Now, GST says if you gift something, there is a levy of GST provided, you can demonstrate that particular transaction is a supply for consideration. So basically, gift would mean that there is no consideration. If there is consideration, it collapses as a gift. Basic fundamental principle of gift is that it's the absence of consideration. When consideration itself does not exist, supply does not exist. So there could be receipt of money without consideration, which may look at from an income tax angle, it may get taxed in the hands of the recipient, but in the hands of the person who gives it, there is no question of tax. In the hands of the person who receives it, there is no question of GST. So underlying supply, is it there or not? You have to see. Of course, I'm not getting to the employee gifts, etc. That's a separate chapter in GST. Then we have this doctrine of mutuality. Right hand cannot activate the left hand, or there cannot be an income without two persons being involved. And fundamental concepts, you have this right from Young Men's India Association case, and then Chelmsford and Bannickpur Club. All of them are very clear that there is no question of income tax. One doctrine of mutuality applied. Doctrine of mutuality is a judge-made law. In this matter was tested in VAT. This matter was tested in service tax, and Calcutta Club Supreme Court is very clear that there is no VAT, there is no service tax if mutuality is involved. But for GST, they amended the law retrospectively from 17 to say that no, we want to tax the association clubs. So even though they may enjoy mutuality in income tax, they may be actually paying GST because of an amendment. There's another interesting concept in income tax called as diversion by overriding title, where the money hits me, but the money does not belong to me. A portion of the money that comes and hits my bank account doesn't even belong to me. It is diverted by overriding title. It belongs to somebody else. Dharmada, for example. So there are a number of judgments as to when it would qualify for diversion by overriding title. Now, whether those principles can be tested in GST. So when is it appropriation? When is it not receipt? So these kind of things are new to GST, but can be applied and tested. Reimbursement. There is no TDS required, strictly speaking, but if somebody deducts tax at source, it has an impact in GST because reimbursements are not taxable in GST, provided pure agency conditions are met. There are about 4 conditions as well as 4 clauses in the agreements which has to be demonstrated. So effectively, I call it as 8 conditions. You demonstrate 8 conditions, then it is pure agency. It is not easy to demonstrate pure agency. But if it is pure agency, the money that comes in will qualify as a reimbursement. Subsidy. GST identifies subsidy that forms part of value, forms part of the price, linked to the price as forming part of transaction value for the purpose of GST. But if it is a general subsidy given by the government for policy or investment, etc., that is not treated as a supply for GST purposes. But as far as income tax is concerned, income would include any assist in the form of subsidy. And of course, one other point is 224 is quite wide. It will talk about duty drawback, it will talk about incentives, it will talk about very various categories of items which are called as income, but some of them may not even have a GST connotation. So what is the way forward? These both laws are fantastic laws. Both laws are brilliant legislations which have evolved over a period of time. And of course, GST is quite new, but income tax is there for many number of years. It has evolved and come to this level. Point I'm trying to make is each law should be understood in the context of that law and assessed in the context of that law. You should not be unnecessarily comparing these two because you are comparing not even apples and oranges, you're comparing apples and dry fruits. So when you compare apples and dry fruits, you'll have those kind of questions that come. So government should re-examine the current exercise of comparing IT returns and GST returns and vice versa. And Form 26AS and AS need not be the only basis for coming to a conclusion that there is an income. The TDS that has been done, wrongly or rightly, banks could deduct TDS even without the transaction being attractive. For example, the kind of TDS that is done sometimes by various parties, you will never know whether the TDS is applicable or not. There should be an understanding that both income tax and indirect tax operate in completely different fields and have limited convergence points. Challenges in reconciliation should be understood from an ease of doing business perspective. This is from the overall wish list. But from an industry perspective, you are sitting as a CFO, you are sitting as a manager of finance, you're sitting as a manager of taxation, and it is a single transaction which you do, which can have different kind of effects in both laws. So your understanding of both laws must be strong, and your compliance of both laws must be strong. And you cannot assume that what is the principle in this law would automatically apply to that law, because I pointed out a plethora of differences between both these laws. So a person who's handling both taxes must be careful. At the same time, if a company has got 2 sets of employees who handle direct tax and indirect taxes, consistency is important. Position should be the same in both laws. You cannot have different positions. Of course, interpretation can be different, but you cannot say reimbursement for the purpose of GST, but it is income for the purpose of income tax law. You cannot have different conflicting contradictory stands on the same transaction. That obviously will lead to issues. $5 trillion economy is possible only if trust deficit is removed. There has to be a removal of trust deficit, because while frauds do take place, it's like this. I still remember long back, Nani Palkewala was talking about this in one of his budget lectures long back. He said that in a shop, there is a person is running a shop. There is always a possibility of pilferage. There is some element of pilferage that will happen. But if the shopkeeper focuses entire energy only on that pilferage, business will not grow. Business will start getting curtailed. So yes, there are fake invoices, there are unethical practices, but you should look at it at a long-term perspective and look at it holistically. Out of my total nearly 1,62,000 crores of GST collection in a month, how much is coming through this fake invoice issue? What is the real issue there? So should I change the law so much for the sake of that point, something which is happening? So that is the large level thinking that has to happen, because that will ensure that ease of business will take place. The trust deficit will get arrested. Business will focus with much more energy in terms of business and expansion. Refund should not be blocked because that affects your cash flow. Income tax has moved leaps and bounds in this. Refunds are very, very fast nowadays. It's almost automatic that happens. GST refunds are good in exports, but now all kinds of questions are coming because of these invoices. So those things have to change as far as GST is concerned. There should not be a concept of block credit, because when you block a credit, what happens is that you're saying that you're not eligible for ITC. If you're not eligible for ITC, my cost goes up. My cost goes up, automatically my profit comes down, because profitability is linked with costs. So we need to understand that concept, that how are we looking at everything. There should be an understanding that both income tax, this is already talked about, and then we talked about simplification to arrive at a convergence. And my last point for the day is, my expectation is that just as how GST has completely reformed the indirect tax space, time has come for a massive direct tax law reform. With that, I will conclude. Thank you very much for a patient hearing, and thank you, Taxmann, for hosting. And if there are questions, if somebody can read out those questions, I'll be glad to take it. Yeah, somebody has asked this question: does freelance income earned by a journalist falls under GST? Now, if you're earning freelance income, you'll offer it as casual income for income tax purposes. The GST, you have to demonstrate that there is something which you have done for which you have received this. Some supply must be there. Any activity, if you do for consideration, is taxable. So there must be a supply. There must be an underlying supply of either goods or service. In your case, goods are unlikely. So what is that you're doing that he gave you money or somebody gives you money? If an activity has been extended by you and that activity results in a revenue, it will attract GST, unless you're able to say that we have an employee-employer relationship and therefore this amount should not be taxed.